We saw gold this week hitting record highs north of $4,600. It's still above that level, slightly down, though, in trading in the gold futures, the February futures this afternoon. Our guest says gold is still well positioned to benefit from a weakening in the US dollar as a store of value. Let's get more from Daniel Ghali, Director of Commodities Strategy at TD Securities. Daniel, great to see you. Thanks very much indeed.
Thanks for having me, Andy.
One point you, and I think some observers are making, though, we saw this new pressure on the Fed, this potential criminal charges coming from the U.S. government against Jay Powell. But we didn't see a dramatic reaction over the past 2 days in the U.S. bond market.
Yeah, that's right. You know, the attacks on Fed independence were chilling for Wall Street observers. But the fact of the matter is, and I will say this, foreign holders of U.S. Treasury assets haven't panicked. Right? You can see that the U.S. two-year yield barely budged. Term premia has barely budged. FX markets have not really moved. The only thing that really has moved are precious metals. And in some sense, gold is really the best suited asset to benefit from the U.S. dollar's loss and store of value function. That's been the story over the course of the last year. But again, that also means on the other side that the story in gold is changing. This is becoming a market that is less premised on the wave of central bank demand supporting the gold price and increasingly premised on a continuation in the debasement trade that is now potentially nearing an inflection point.
Yeah, a US dollar has held up. It initially fell, as I'm sure you know, on Monday, but has since rallied. And I guess we won't get in. I mean, you can get into the weeds on this stuff, but you as well are in the camp that maybe Bernanke's has even been strengthened here by this latest pressure with the huge rallying of support, for example, for him. Sorry, I should have said Jay Powell, not Bernanke. I'm living in the past. Go ahead. Yeah.
Yeah, that's right. I mean, that could be an unintended consequence as well, right? Certainly, it seems like Chair Powell might emerge from this as some sort of white knight when it comes to Fed independence. And you have a battle ongoing not only between the administration and Federal Reserves, but also in Congress around this. So I think that what we've seen is that trust in U.S. institutions has bent, but it's not broken. And you have these ongoing battles that can swing in favor of U.S. institutions as well. Most importantly is the upcoming Supreme Court case that will determine whether or not the Trump administration can exit sitting Fed Governor Lisa Cook.
That's interesting. If it was to go that way and Trump and his colleagues could squeeze her out, would that again cast a shadow over the U.S. dollar?
Absolutely. And I'd say that would probably be far more significant than what we've seen thus far. So far, perhaps the reason that trust in U.S. institutions hasn't broken is because they've not really been put to the test. And this is the first major test that they'll be facing.
What would be your view on gold? Does it have a prospect of getting to 5,000? I see Citi is now joining the camp of watchers who say, yep, gold 5K is quite plausible.
I mean, it does. Firstly, the gold vol has been significantly higher. So $5,000 an ounce doesn't even seem all that far from current market prices. But more significantly, what we're trying to get to is the fact that the debasement trade does have room to strengthen further over the course of 2026, and it also has the room to reverse. There's two-way risks in gold markets for the first time in several years, underscored by the fact that gold is actually no longer a fringe asset. In fact, the most popular physically backed gold ETF is now roughly 65% as widely held by institutions as the most popular ETF in history. That's a symptom of the debasement trade that took place over the last year. And the consequence of that is that for the next leg of debasement to really kick in, what you need is the shift in asset allocations, that those institutions place more capital into gold and potentially into commodities than they have in the past. It's certainly possible, but there needs to be quite a few series of tactical mistakes from the U.S. administration before that happens.
Let me just unpack that. First off, that ETF figure you gave, you were comparing the holdings in the biggest gold ETF to the holdings in the Spider S&P 500?
I'm comparing the number of institutions that hold the most popular gold ETF to the most popular ETF in history.
Okay. And then, sorry, so this more widespread holding of gold, Daniel, that could have a downside if the crowd decide to get out rapidly?
Yeah, I mean, if you think about it, what's occurred over the last year in terms of the debasement trade has largely been a function of sentiment. Warranted, but sentiment nonetheless. The pace of debasement can be dictated either by government actions or by market forces. And in the case of the 1970s, you had a strong case. Inflation was rampant, et cetera. That was a market-based debasement event. Over the last year, that hasn't really occurred. Inflation has been coming down. It's been well constrained. Inflation break-evens are pointing to subdued fear of inflation resurgence. So really, what it has boiled down to is trust in U.S. institutions that has weakened. Is there scope for that to strengthen from current levels is really key to answer your question.
Daniel, thank you very much. So, Daniel, sorry, we've only 30 seconds. Would you be a buyer of gold with new money right now? Do you say with a 6-month time frame?
Well, we are more neutral on gold at current prices. And in fact, we see further opportunities in other precious metals than gold and silver.
So are you more bullish on silver, for example?
On platinum group metals in particular.
Thank you very much, Daniel. I really appreciate it. Daniel Ghali, Director of Commodities Strategy at TD Securities.